Chapter 9. Forex. Markets. Forex is foreign exchange, same as currency. Alright. Let's see what we have. We have currency appreciation, currency depreciation. Appreciation means goes up in value, depreciation means goes down in value. Then we said about currency dealers, currency brokers. Yeah, we got a lot of visitors here. Oh, just a second, it's okay. Currency dealers, currency brokers. We got dealers, will be also market makers. Next one is currency intervention. In general, in finance, in economics, intervention means governments trading on the market to manipulate the price of a particular asset. So it's government manipulating the price of an asset in order to achieve an economic goal. Government will intervene in bond markets to manage interest rates. Government will intervene in currency market to manage exchange rates. Currency intervention is governments buying and selling their own currency to manage their own value. So why would government intervene? When the government makes currency appreciation and currency depreciation, when the government depreciates its own currency, in other words, our currency falls, it makes our exports cheaper. Exports cheaper and exports go up. So, government will intervene in the currency market to make the currency cheaper. When you make your own currency cheaper, you make exports cheaper and you stimulate, meaning the government stimulates exports and discourages imports. When the currency depreciates, means that people get poorer. Your money is worth less. Now, when currency appreciates, the currency goes up. Everybody's money goes up in value. You can buy more Japanese cars and you can buy more Swiss watches. So, when the currency appreciates, you can buy more foreign goods. Foreign goods become cheaper, so imports goes up and exports go down. So governments will intervene in the markets, in the currency markets, in order to possibly increase exports and cut down on imports. The result of, all right, let's do the next definition. Trade deficit. Trade deficit. trade deficit will be the surplus of imports over exports. So trade deficits will tell you how much more you're importing than exporting. Trade deficits signify that the economy is weak, the economy is incapable of producing, and that the economy is capable of either satisfying its domestic needs or incapable of satisfying foreign needs. So trade deficits are a general indicator of an overall weak economy. One of the best examples of a weak economy with massive trade deficits for decades will be the United States. Okay? The opposite of trade deficit is trade surplus. Trade surplus means that exports exceed imports. Here, the trade deficit means that imports exceed exports. Okay. So the government will intervene on the currency market in order to manage the trade deficits. So appreciation of the currency will worsen trade deficits, and currency depreciation will improve trade deficits if the country has a deficit. So China has a strategy of currency depreciation and what is known in economics, now switching from finance to economics, as export-led growth, economic growth. So by keeping the currency cheap and cheaper, in other words, by constantly depreciating the currency, China tries to stimulate its export and tries to grow its economy by growing its export. This is the model that Japan used 40, 50 years ago, where Japan kept its currency cheap, and as a result it was able to increase its export and become an Asian economic superpower, second only to the United States. So that's on currency intervention. Now, what may happen is the following. You may have the Japanese government trying to depreciate its currency in order to stimulate exports, let's say, to China. And now the Chinese government trying to depreciate its currency in order to stimulate exports to Japan and the rest of Asia. And when one country tries to depreciate its currency and another country tries to depreciate its currency, this is impossible. Exchange rate is, remember, one currency goes up, another currency goes down. You cannot have both currency goes up, and it cannot have both currencies go down. It's mathematically impossible. Exchange rate is just the ratio between two currencies. One currency going up means the other one going down. One currency going down must mean the other currency going up. Now, when two governments try to depreciate their own currency, what you get is a brand new phenomenon from the last 5 years. It's called a currency war, where each government is trying to depreciate its currency more than the other government. So they get into a form of financial war where each government tries to export its way out of economic crisis. In other words, the economy is in trouble, there is no demand, people are up to here in debt, corporations are deep in debt, government is deep in debt. So the only way the government sees to grow its economy is through exports. That's how the Japanese see it, that's how the Chinese see it, that's how the Europeans see it, and that's exactly how Americans see it. So right now we are in currency war 3, and I can't get into the history. They've been previously currency wars. The first one, let's say, was about 80 years ago during the Great Depression, where countries tried to, we say, cheapen is the same as depreciate, to cheapen their currencies in order to get their economy out of a major economic depression. All right, let's see what's next. We said over-the-counter markets, so most of currency markets are over-the-counter market. All right, international whatnot, okay. I discussed the forward market, did I? A little bit?
Yes.
Okay, discussed the forward market, okay. The main trading centers, currency trading centers were London, New York, Tokyo. The new ones are Singapore, Hong Kong, and the fastest growing financial center in the world is Shanghai. Okay, that's good enough. Let's see. Foreign exchange rate. We discussed spot transactions, right?
Yes.
And then forward transactions. Okay, we did that. All right, we have foreign exchange traders. Okay, we discussed next money center bank, right? Money center bank is located in a financial center which relies not on deposit like most banks, but relies mostly on borrowed funds. These could be Fed funds and repurchase agreements and so on. All right, let's see what else we got in here. We discussed last time currency positions, and the position could be long, the position can be short. Then we discussed net long position, net short position. So we're going to have a net long for a particular currency, net short for a particular currency. And then we discussed net exposure or currency net exposure. And currency net exposure will tell you your long and short positions relative to other currencies. And this will be the measure of currency risk. Currency risk, which is the risk or probability that the currency will move against you and result in losses. In this particular case will be currency losses. Okay, net long, net short, okay. Next one is, of course, foreign exchange. I'll shorten it forex. Portfolio is a portfolio of all of your currency next exposures. And portfolio is a collection of assets. Could be collection of stocks, could be collection of bonds, could be collection of real estate, could be collection of currencies, could be collection of commodities, okay? Could be collection of gold and silver, precious metals. And a portfolio could be collection of all of these asset classes. Your portfolio will have some stocks and some bonds and some real estate, some gold, and so on, some currencies. Okay, let's see what else we got. We discussed these net exposure as another term is open position. We did this last time, right? So open position, open is the same as unhedged. Unhedged. Open position is the same as unhedged. Open has the meaning of exposed, as in open position means that you have a exposure, okay? Exposure is the measure of risk. So open position is unhedged. To hedge means to lower or eliminate your risk. Unhedged means that you have not reduced your risk. Means you're exposed to risk. Let's see what else we got in here. Open positions. Okay. Last time somebody said, if you hedge, hedging is the process of reducing your risk. Could be, you can hedge your stocks, you can hedge your interest rate risk. When you hedge your stocks, you have market risk, okay? You can hedge your bonds, okay? You can hedge your real estate possibly, so you can hedge your currency. So as long as you have a risk, the way to reduce it or reducing that particular risk is hedging. So hedging can go on the balance sheet. And on balance sheet will basically means that you will have to reduce your net exposure. If you have a long exposure, you reduce the long exposure. You reduce your long position. Or if you have a long exposure, you will take a short exposure. You will get an obligation. So if you have a net long position, you will borrow in that currency. If you increase the liability in that currency, the net position will go down. So that's on balance sheet. Long exposures get countered with short exposures by increasing your shorts. Or if you're short, for example, you will be importing motorcycles from Japan, you'll need maybe Japanese yen, and you have a short exposure because you got to make a payment after 3 or 6 months. You will counter it by taking a long position. You will increase your long position in Japanese yen. So that's on balance sheet. It's recorded as a currency. And the off balance sheet hedging. When you hedge, it is not in any way recorded on the balance sheet. It's not recorded on the balance sheet when you have a forward contract. In this particular case, it will be a currency forward. So when you have a currency forward, you make a commitment, contractual commitment, that you will exchange the currency in a future date, maybe 3 months, maybe 6 months down the road, and that will reduce your exposure. It could be a futures. Contract, and I'll be probably discussing a lot more about futures, whether it's stock futures or commodity futures or currency futures in the next chapter. So, could be on balance sheet and off balance sheet. You may have, we discussed last time, now change the color. Contingent. Liability. This is not a liability. It is only given a particular event, it may become a liability or it will become a liability. So a contingent liability today is not a liability. It is only the risk that if a particular event occurs, it will become a liability. For an insurance company, they took your insurance money, they have a contingent liability. If you have a car accident, they'll have to pay you insurance. But if you don't have a car accident, they don't have to pay for you anything. So that's a classical contingent liability. Contingent liabilities depend on some sort of event, whatever the event might be. So there is a possibility that you may have contingent currency liability, contingent foreign exchange liability. That's a possibility. Okay, let's see what else we got. Oh, okay, now I begin to remember. We were up to interaction of exchange rates, and then we got interest rates, and then we got inflation. Okay, that's section or goal number 7, page 271. And this is where things get very, very, very messy. If, let's do this. This is tricky. If interest rates go up, means investors think or will see your currency as more attractive. If interest rates go up, let's say in Cambodia from 5 to 10%, investors in Japan, from Russia, from the US will try to invest in your country. When they try to invest in the country, it will make the currency more attractive. The Japanese will have to buy the local currency. So in general, when interest rates go up, the result is that it makes foreigners invest in the country. Foreign investments will rise. When foreigners buy the currency, the exchange rate will go up. So, raising interest rates will result in a higher exchange rate, will make a currency stronger. So that's the one relationship. It's more complicated than that. When you raise interest rates, it makes people save more and spend less. So raising interest rates results in lower inflation. So let's try to do this. Monetary policy. Monetary policy, the government will manage interest rates. So the government will manage money supply and interest rate. The typical monetary policy is the government will lower interest rates. When the government lowers interest rates, it becomes cheaper to borrow. People borrow more and spend more. So spending goes up. And the result is overall higher inflation. Okay? That's a basic tool of modern central banking monetary policy. You stimulate the economy, you stimulate spending, expenditures, and stimulate inflation by lowering interest rate. Well, if the economy, inflation begins to rise and spending gets to rise, and you want to control spending and inflation, central banks' monetary policy response is raise interest rate spending goes down, also borrowing goes down. Here with lower interest rate, borrowing goes up and spending. Borrowing and spending go hand in hand in most developed countries. And inflation goes down. So in general, you have this relationship. So that's interest rates go up, inflation go down. Now, let's go one step further. So, we already described how interest rates affect exchange rate and how interest rates affect inflation. But now there's a completely different relationship. Inflation affects interest rates. If inflation goes up, inflation can go up for many reasons. Price of oil can go up, okay? There may be internally a war, okay? Exports may become more expensive. In other words, prices can go up for a whole bunch of reasons, including people borrowing more. People borrowing more from local banks, they may be borrowing more from abroad. Either way, when inflation goes up, we have the economic relationship that interest rates go up. Okay, and this is known as, let me see if you have it in here. We don't have it in here. This is known as the Fisher equation. Fisher. Equation. It goes like this. Interest rate nominal, interest rate nominal equals interest rate real plus inflation. You studied this already? Yes. Right, so this is it. Very simple, very, you got it? Okay, just take a little nap. You got a point out there, right? So everyone can see. Okay, so nominal interest rate is equal to real interest rate plus inflation. Okay, so it's the most basic, and here we'll all talk about nominal interest rate. So if inflation goes up, investors will demand higher interest rates. Okay. So here the relationship works in reverse. Higher interest rates, lower inflation. On the other hand, higher inflation raises interest rates. Okay. Well, that is the balance between interest rates and inflation. Higher interest rates, lower inflation, okay? Lower inflation, lower interest rates, okay? So basically, inflation counteracts interest rate. All right, let's write it up. Interest rates go up. Inflation go down. And now lower inflation will result in interest rates going down. This is stabilizing the market. So rising interest rates will lower inflation and it will lower interest rate. We call this a negative feedback loop. This will keep interest rates in balance. They can't just keep going up and up forever. Okay, because lower inflation will get to push them back down into equilibrium. So now we got to figure out some relationship between exchange rate and inflation. Well, that one is easy. When inflation goes up, it very simply means when inflation goes up that your currency becomes cheaper. So rising inflation results in depreciation of the currency. When inflation goes up means your money buys less. And when inflation goes up, means your currency is worth less. So rising inflation almost always means weaker currency, means depreciating currency. So rising inflation means that the exchange rate will go down. Okay? So when inflation rises, it pushes down exchange rates. But the opposite is also true. Governments will lower the exchange rate, and when the government lowers the exchange rate, it makes exports more expensive. So when you bring the exports, it becomes more expensive. So motorcycles get more expensive, everything you import more expensive. So this relationship goes both ways. Lower exchange rates will drive inflation higher, and higher inflation will drive exchange rates down. So you got inflation affecting interest rates, exchange rates, and exchange rates will be affecting inflation. Okay? And now we gotta see, well, do exchange rates affect interest rate? And as you might guess, stronger exchange rate will actually lower interest rates. So, stronger exchange rate will lower interest rates. Now, okay, that's a neat, cheap trick that I can use. During the 1950s all the way to 1990s, the best example of strong, very strong currency was Switzerland. Switzerland kept its currency extremely strong. It has been for 50 years the strongest currency in the world. And being a strong currency, meaning the Swiss allowed the Swiss franc to go up, means that the Swiss franc was getting higher and higher, and Switzerland enjoyed one of the lowest interest rates in the world. The second country that enjoyed a very strong currency was Germany and the German Deutschmark. Germans allowed its exchange rates to rise, and when the exchange rate rises, it brings in foreign capital for different reasons, and interest rates go down. So you have a general natural relationship that strong currencies usually maintain relatively low interest rates. So that's the basic relationship. You got interest rates affecting exchange rate and inflation. You got inflation affecting interest rates and exchange rate. Interest rates and inflation both ways. And now I got the exchange rate affecting interest rates. Well, all of this thing, again, it's relatively complicated. Well, let's go here. Camera got moved to the other side. Is known, we're getting into one of the most complex topics in international finance, known as the purchasing power parity. Let's see what the textbook says. Okay, well, one way to understand it is the following, is that changes in exchange rate, so the change in exchange rate, so your exchange rate will go up or the exchange rate will go down. So the change in your exchange rate, let's say relative to China, will be equal to the change in inflations. So you take Chinese, let's say, okay, let me rewrite it like this. Inflation of China is 5%, and let's say inflation in Germany is 1%. So China has a relatively high inflation, and Germany has a relatively low inflation. So the change or difference in inflations is 4%. So this will mean that Chinese currency will fall relative to the German currency, to the euro, by 4% to maintain purchasing power parity. The best way to think about it is with a single commodity, a commodity which is traded on the both markets. Well, let's try China and Japan, China and Cambodia. The commodity will be rice, okay? Rice is traded there, rice is traded here, okay? Suppose now that in China, okay, let's try this. China has 5% inflation. Now I change my example to Japan. Inflation in Japan is 1%. Okay, so rice in China will go up. In China will go up by 5%. Okay, and rice in Japan will go up by 1%. Okay, so now in China rice has gone up a lot, and in Japan price of rice has gone up very little. What's the result? The result is that all the rice from Japan and around the world will go in China because you can sell it in China for a higher price. Okay, so the rice will have to go in China, and this will basically mean what? This will basically mean it's going to be less rice in other countries. Well, if the Chinese try to import all the rice from Japan and other stuff, in other words, if they're going to start importing, this basically means that the Chinese currency will go down. In other words, price of rice in Japan and China will still be the same. If the price of China of rice went up by 5%, the Chinese currency will fall down 4% to compensate and make the price of rice the same. So the purchasing power parity means equality. The purchasing power means that if the price goes up, the currency will go down to compensate for the higher price. You're not going to be able, as a Chinese, to just keep buying all the rice from Japan, okay? If you buy all the rice from Japan, you got to pay the Japanese with your currency. When you pay the Japanese with your currency, the Japanese will sell your currency. Okay, that's another basic relationship. Let's try another basic relationship. Again, things are getting very complicated. Things are getting very complicated. When imports increases, okay, a nation is trying to import more, okay, you're trying to import more Japanese motorcycles and everything else. So when imports go up, okay, this means that one of two ways. You pay with domestic currency, okay? Pay with domestic. When you pay with domestic currency, In other words, let's say China and Japan. The Chinese pay with Chinese yuan to the Japanese. When you pay with the domestic currency, it means that the foreigner will sell the domestic currency. And the result will be that domestic currency falls. So, you're China. You pay with Chinese yuan to the Japanese. The Japanese don't need your currency, so the Japanese will go on the international market in Hong Kong, in Singapore, wherever else, and they will sell your currency. So, when you increase your imports and pay with your domestic currency, the result will be basically that your domestic currency will fall. So, imports rising will cause the exchange rate to fall. Now, if with your imports, let's say you pay with foreign currency, pay with foreign currency, let's say you pay with dollars, okay? Then, when you pay with dollars, your Chinese yuan, the Chinese yuan to US dollar ratio, you are having less dollars. So, the Chinese yuan, you got the same number of yuan, you got lower dollars. This means that yuan to USD ratio will go up. This means it will take more yuan for the dollar, which is the same as the Chinese currency going down again. In other words, the Chinese will have their own currency, now they're going to have less dollars. The ratio of yuan to dollars will increase, which is the same as that each yuan will be worth less. So overall, either way, again, it's very difficult, very complicated. Usually there are whole courses in international finance that raising imports will lower the exchange rate. Well, that's the purchasing power parity. If inflation is higher and inflation drives imports, the result will be weaker exchange rate. So that's another way to rewrite it. So let's say this. Inflation going up in one country will result in imports going up, will result in exchange rate going down. Okay? So that's a very, very basic relationship, and it's a relationship of the purchasing power parity, which basically says you increase your inflation by 3%, you will lower your exchange rate by 3%, the corresponding. Okay, let's see what else we got over here. Purchasing power parity, that was very difficult. I already wrote this. Let me see where and how. I already wrote this before. So, purchasing power parity is shortened as PPP. Purchasing power parity basically says that change in exchange rates is driven by or equal to the change in inflation. Now we have, that's on the next page, 272. Purchasing power parity theorem, which basically says that change in interest rate will equal to change in exchange rate. Basically, if the government has a weak exchange rate in foreign currency, the government must raise interest rates at home to attract foreign capital, okay? So now you can also see that from this relationship, the extended relationship becomes that changes in interest rates affect changes in exchange rates, affect changes in inflation, all right? But again, you must remember that these are two-way relationships. A few more minutes to finish for today. I'm pretty much finished, okay? Balance of payments. It's probably going to be next time. Balance of payments is determined by the current account and the capital account. You guys already studied this before? You studied before?
Yes.
A little bit. Okay. So what are the elements of the current account? The main element is trade, as in exports and imports, and the trade deficit, technically the trade surplus. The second element will be, in current account, will be in net investment income. Investment income. In other words, you invested in some Japanese bonds, you get from the Japanese interest rate, okay? Or net investment income is you invested in Japanese real estate, now getting rent from Japan. Or, which is a lot more likely, Koreans invested in real estate over here, now they collect their rent and bring it back to Korea. So, for Korea, it's going to be a current account surplus. For Cambodia, it's going to be a current account deficit. And the other one will be gifts and grants. Gifts. Gifts and grants. It will be an American guy who's got a girlfriend over here in Cambodia, and he sends her $300 from the US over here, which is a pure gift. Again, there was no work or anything. There was no work, there was no commodity, there was no motorcycle or anything else. So there's no genuine investment, pure gift. And the capital account is associated with one thing: investments. Koreans coming and buying stocks over here. Koreans coming and buying bonds. Most likely Koreans coming and buying real estate over here. So an investment in general, the capital account is associated with buying assets in the foreign country. But not buying consumption assets like you buy rice. That doesn't count, you know. It's got to be an investment type asset. You buy stock, you buy bond, you buy real estate, you buy some sort. Now, you can buy a restaurant, and the restaurant will still be an investment. It will still be a business, okay? So, you're not buying consumption goods like rice. You're not buying gasoline, which you use for a motorcycle. You buy motorcycle, which you use for a taxi. Okay? So, the total of the current account and capital account is the balance of payments. Now, if the balance of payments is positive, means that foreign currency, come on guys, the two of you, hey, one more minute, okay? The two of you. When your balance of payment is positive, this means foreign currency is flowing in your country, you get more foreign currency, and it's strengthening your currency. So a positive balance of payment is usually results in stronger exchange rate because you bring in more foreign currency. Foreigners want to buy your own currency. And when the balance of payment is negative, means that your currency is flowing out. You're not bringing enough foreign currency, your exchange rate goes down. And that is it. That's the end of the chapter. Very difficult, very complicated, but unfortunately, international finance is always difficult and complicated, but that's a short story. All right?